Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, June 9th, 2023. As of yesterday's close, stocks are no longer in a bear market. That's because the S&P 500 index has rallied 20% off of its low last October, undoing most, but not all of the damage done since it started falling 18 months ago, as shown in this chart. And if you follow my cursor here, you'll see over on the left half, S&P 500 peaked at an all-time high around 4,800 about 18 months ago. As we got, into 2022, that's when inflation numbers really started rising. In March, the Fed began raising rates, and then you can see this downward cycle that bottomed out last October. Since then, just the opposites occurred. But the problem, of course, is a 25% decline, which is about what the index fell from its peak to its bottom, requires a 33% gain to basically get even, and we've gotten maybe a little over half of that in the form of a 20% recovery, but nevertheless, this is good news. And from a technical perspective, you can see, you may recall in a couple of previous updates, I drew a line showing that the top of these cycles all topping out around 4,200, where the bottoms of the lows were getting progressively higher. Now you can see as of this afternoon, the S&P 500 is well above that 4,200 resistance level. The next resistance level is around 4,600, which is about 7% higher than where it is now. So all of this sets the stage for next week, when we will get the Consumer Price Index numbers for last month on Tuesday, followed by the Federal Open Market Committee's interest rate decision on Wednesday. Now right now the expectation is for the CPI numbers for May to not really look a whole lot better than April's, but to not look worse. And that in turn that will induce the FOMC to basically leave interest rates unchanged, or pause, at least this time around. Now there is an argument to be made for raising rates next week, and it's really two things. One is CPI is not coming down as fast as hoped. In fact, it appears to kind of maybe stalled out. And new jobs were added to the economy at a much faster rate than expected last month. So the Fed's whole idea of demand destruction to drive down inflation doesn't really seem to be working. The argument against a rate hike is that Europe just reported its second consecutive quarter of economic contraction, so it's now officially in recession, and the fear is it may be a harbinger for a lot of the rest of the world. So I think the FOMC will not raise rates this month when it meets next week, especially since we have not yet seen most companies' Q2 results and guidance for this year. Most of those reports will come in like during the second half of July, first half of August. We'll also get the advance estimate of gross domestic product in this country during for the second quarter on July 28th. And at that time, we should have a much better idea of how our economy is performing. So in other words, now would be a good time for everyone to take a breather and wait for more empirical data to come in before taking action. There's no compelling reason to disrupt the new equilibrium that has been established among the stock, bond, and commodity markets. That said, there is one aspect of the stock market that bears scrutiny, and that's the big run-up in tech stocks that are at the forefront of the artificial intelligence revolution. You may recall a couple of weeks ago I commented on NVIDIA, which we added to the PF Growth portfolio last October, around $120 a share. That stock has just gone through the roof. It's considered kind of the poster child for artificial intelligence. But if you look at it during the past year, our timing, quite frankly, was pretty much perfect. We added it back in October around 120, and then after it released its Q2 results a couple weeks ago, it's now up around over $390 shares. It's more than tripled in price in 8 months. And yeah, that's great if you bought it back in October when we added it to our portfolio, but even still, that's a huge run-up in a short period of time. And that momentum has triggered big moves by other tech stocks that have driven the NASDAQ Composite Index up 27% so far this year, compared to a 12% gain by the S&P 500 Index. In my opinion, some of those stocks have become overbought and are vulnerable to a quick sell-off if there is any unexpected bad news next week concerning inflation or monetary policy. In short, I think it's time for investors to sit tight and wait for more information. The stock market's gotten off to a good start in 2023, but we don't know yet if it can maintain that momentum over the second half of the year. So that's this week's PF Video Update, and I look forward to talking to you next week. Thank you.